What are state reciprocal tax agreements for us taxpayers? Imagine living in one state but working in another every day. It can get complicated when it comes to paying taxes. That's where state reciprocal tax agreements come into play. These agreements are arrangements between two or more states that simplify your tax situation. If your states have a reciprocal agreement, you only pay income tax to your state of residence. You don't have to worry about paying taxes in the state where you work. This can save you time and reduce the chances of paying double taxes on the same income. In most cases, if you live in state A and work in state B, and those states have a reciprocal agreement, you only file and pay taxes in state A. You usually don't need to file a non-resident tax return in state B. This makes your tax filing process much easier. These agreements are mainly for state income taxes, not federal taxes or other types of taxes. They are designed to prevent you from paying taxes twice on the same earnings. There are two main types of these agreements. The first is bilateral, meaning both states agree to exempt residents from paying taxes on wages earned in the other state. For example, Maryland and Pennsylvania have such an agreement. If you are a Maryland resident working in Pennsylvania, you only pay Maryland taxes. The second type is unilateral, where one state decides to exempt income earned by its residents in other states that have similar rules. Indiana, Minnesota, and Wisconsin are examples of states with unilateral agreements. Knowing if your states have a reciprocal agreement is especially helpful for Asian American taxpayers. Many live in one state and work in another, especially near state borders. If you know about these agreements, you can avoid extra paperwork and ensure your taxes are withheld correctly. If your states do not have an agreement, you might need to file both a resident and a non-resident tax return. But your home state may give you a credit for taxes paid to the other state, helping you avoid paying twice. To benefit from these agreements, you usually need to fill out a specific form and give it to your employer in the work state. This form tells your employer not to withhold taxes in the work state and to withhold only for your home state instead. If taxes were taken out incorrectly, you might need to file for a refund from the state where the taxes were wrongly withheld. In summary, these agreements are a helpful way to make tax time less stressful for people who cross state lines for work. They let you pay taxes only in your state of residence, saving you time and effort. If you work near state borders or in multiple states, understanding these agreements can make a big difference in your tax process.